Hello and welcome to the DIY Investing YouTube channel. We're going through every company in the S&P 500, and today is Ameren Corporation, ticker AEE. In the next 5 minutes, I will go over what I think about the valuation of this company and what I think about the quality of this company. So let's dive straight on in. First up is the industry, multi-utilities. That immediately gives me a negative feeling. Utility companies have a history for low returns and low ability to return high return to shareholders. We'll see if that's true. First, look at the business description. So, Ameren Corporation operates as a public utility holding company in the United States. That's significant. So, it's in Missouri, Illinois, natural gas transmission. So, they operate all different types. They're both the rate-regulated electric utility generation. Rate-regulated is a bad term for us here as shareholders. Rate-regulated natural gas distribution, and it primarily generates electricity through coal, nuclear, natural gas, as well as renewable sources. So they are producing electricity. Now, the beta of 0.346 is appealing. It means it's relatively low volatility. That's a good sign. Share turnover there is meaningless for us. Return on invested capital. So what you're going to see is they only lost money in 1 year. That's good. So having profits in 19 of the last 20 years is a nice metric I like to hit, where you only allow one loss in 20 years. That's good. However, the return on invested capital is very poor. You can see their highest year in the last 20 years was 20 years ago at 6.8% in 2001. And then in recent years, you're below 5%. So that means without low debt rates, they're unable to really turn any economic profit. They're not even earning their adequate returns on capital to justify their existence. And so a lot of this is due to what we saw before with rate regulated. So quick up, although these are stable, bad business, very unlikely to keep this company on my watch list, but let's see if I can change my mind with further information. You see the return on equity can get up to 8% from these 4% returns on invested capital, because again, that's using their debt to leverage it up. The PE ratio of 23 is ridiculous for a company with these level of returns. And the fact that they're trading above book value when you're unable to get a return on equity in the double digits is a bad sign. In order to justify returns on equity below 10%, your book value that you need to pay is less than 1. So if you're paying return on equity of 8%, then you need to pay less than a book value of 0.8 in order to justify buying that business. Not only that, is they're reducing revenue over time. So the PE ratio needs to be not just 8, which would be a no growth business, but a negative growth business should be a PE of like 6 or 7 to justify that and still achieve something like a 10% rate of return. Now, not only is their revenue going down, but their assets are growing over time because they're having to reinvest in the business. Now, EPS is at 19.7%. I don't know how that is, and something is clearly wrong here, because 20% EPS growth should have meant that this $2 earnings per share should have gone to something like $8 in earnings per share over time, but it's only at $3.50. It's not even doubled. And so that real earnings per share number is something like 6 or 7%. And so that's not an accurate number here. Let's see the income statement to see how their shares outstanding are going. So they're not even buying back shares. So this is, again, another bad sign with this company. You can see they lost money in 2012. Positive operating profit every year, so that's a good sign. Let's see, balance sheet. So their PP&E has grown from $17 billion to $26 billion. That's up about $9 billion over the last decade. And their long-term debt has grown by about $3.5 billion. So they have $11 billion in debt. Let's see how compare that to their market cap of $12 billion. $22 billion. So again, a third of their balance sheet is debt. That's pretty normal for a utility because they're trying to bump up that return on equity. But it's clearly not good enough to save this as an investable business because the returns are just too low. So cash flow statement. Again, positive cash flow from operations every year. That's good. But as you can see, a lot of this money is having to go back into reinvesting into the business. Now, they're not defining it as property, plant, and equipment, so I don't know what this other is, but it's not good. They're having to issue new debt, not every year it seems, but they are having to put a lot of this money, sometimes more cash, into investing than they have from operations. So this is not a sustainable setup for this business. So, I mean, again, the hurdle here for utility stocks is just really high because the returns are so low. If you want to earn a 10% return on investment, then you really need to invest in a company with a more than 10% return on investment. And this utility company just does not have it. They don't have a single year in the last 20 years where they've had a 10% rate of return on their invested capital. So for me, it is a pass. It doesn't even hit my watch list. This is going to be probably pretty common with the utilities. And generally, they're worth avoiding. There's many more companies out there, and you can build a whole portfolio with high-quality companies, and that's what I would recommend. So hit that like video on this video. Don't forget to subscribe and hit the bell so that you can get notifications as I release new videos and work through all of this playlist. And thank you for listening. Until next time, stop paying fees, start building wealth.